Hey guys, this is Mark from TRADEPRO Academy, and in this video we're going to be looking at the most popular indicator in the industry, the moving averages. Right, so first thing we're going to go through is identify the two most popular types of moving averages. These are the exponential moving average and the simple moving average. Now what a moving average does is it simply calculates the average closing price over a certain range and then divides that sum to give you the mean average closing price. So what that would look like is something like this. So in this example, we have the EMA, which is the exponential moving average, that's the yellow guy, and the simple moving average is the red one. They're both set at 20 period closing, right? So what that means is we've got the close set here. You can have a variety of options. We prefer to see the average of the closing prices. All right, guys, so what is essentially with the moving average located? If you see us scrolling on the side, you can see during periods of trending markets, these guys are pointed up, and during periods of bearish trending markets, these guys are both pointed lower. So what's the difference between the simple moving average and the exponential moving average? Simply, it's the calculation, it's the way that it's calculated. The simple moving average just takes the prior 20 days closing prices, adds them up, and divides them by 20. Right? The exponential moving average is a little bit different in the sense that the calculation puts more weight on the more recent data points. All right, so where the simple moving average is capturing the data over the last 20 periods and giving it equal weighting for each day, the exponential moving average puts higher weight on the most recent data points. So in this example, you can see that the yellow line generally tends to move above the red line when prices are moving higher, and it tends to be below the red line when prices are moving lower. This is because of that calculation and because there is more weight on the most recent data points for the exponential moving average. So which one is right for you? That really depends on your trading style. If you're a short-term day trader, even a intra-week swing trader, you could look at using the 10 or 20 period moving averages. Those generally tend to hold well during trending periods. And if you're a medium-term swing trader, you would be looking at the 50-day moving average, and longer-term position and investing traders, they can look to optimize the 100-day moving average as well as the 200-day moving average to find levels where they can do business. All right, so now that we've got the basics covered, I'm going to introduce you to how you would want to use these kinds of indicators. So the basic tenets of the moving averages are to use them in one of two ways. So your first option is to use it as a trend filter. So what that means is if you were to have one moving average plotted on your chart, you can use it as a trend filter in the sense that if prices are trading above that level as they were here, you could be looking to take lower term time frame trades to the upside as long as prices remain above this moving average. Now, moving averages, there is a caveat with them in that they tend to work best in trending markets. When the market's consolidating, as you can see here, after this big rip up, we had our first breakdown below that moving average. Now, that doesn't necessarily mean that the trend is just going to simply reverse. What that usually signals is that this run up is coming to a potential halt and that we may be coming into a period of consolidation before our next move. So in this case, that first break back down below this moving average signaled to us that this bullish run may be coming to a halt and that we may be going into a period of consolidation, right? So we had that period of consolidation here, and then price traded back into the middle of the range and pushed back lower again At this point, we were back under the EMA, and you could start looking to qualify shorts as long as prices sat below this 20-day moving average. So that is essentially your first use of these moving averages, is to use them as a trend filter, i.e. using them as almost like a green light, red light, if you will, for your trading plan. Price is above the 20-day moving average on the daily, then you can start looking to qualify longs on the 4-hour, 1-hour time frame. Price is sitting in between these moving averages. You're going to want to stay out of the markets. Once we see price give us a clear direction and the price is moving well under this moving average, that will help us qualify further shorts as price moves lower and stays below that moving average. Again, here, once price broke back above that moving average, in this case, the trend did reverse back to the upside. However, this in itself is not an indicator to go long. You want to add confluence to your trades, but as a filter, you can start looking this to say, all right, the bear side may be done here. Now the bulls may start to take control of this market and push it higher. So there is your first use of the moving averages. The other use of the moving average is especially good during trending periods in the market, and that's to use them as dynamic support and resistance. So as you can see, when price is moving here, I'm using this example here, price is moving higher, it's using that moving average as support. So if you're seeing longs and prices dipping back down into that level and holding, forming wicks, that could be seen as a good area of value within this trend to ride prices higher. And alternatively, if prices move lower, any retracements back into that level should be seen as selling opportunities. As you can see here, we got to move back into the MA, rejected it, and we pushed prices lower until we broke back up, started this consolidation, and now we're currently moving higher, as we can see with this 20-day moving average pointed higher. You can also see here on this breakout of this key level here at 113, prices consolidated and used the 20-day moving average as support, as dynamic support, before prices continued higher. So at this point, the Swissy Jappy Yen pair looks to be poised to trade higher up into this 118.640 level. Do we see that happen right away? I don't think so. What can be likely is that we see another consolidation like this. So as this EMA moves higher and price consolidates sideways, it should drift higher and find it as support for a push back up into this resistance here at 118.640. Another good use of these moving averages is to use them, is to have two of them plotted on your chart. So in this case, let's say we want to have the 20-day moving average and the 50-day moving average. So let's go ahead and plot that on our charts here. So the 20 is the yellow and the 50 is the red, right? So what you will notice here is that when price is trending, so for example, in this market here, you can see that we had a pretty nice downtrend since from July to July, basically a whole year's downtrend. And what do you see throughout this whole downtrend? When these EMAs cross over, that could be an indication that the trend is potentially looking to change. So you can see here prices consolidated, pushed up, held this level as support, pushed up higher, and then we had a break below both of those moving averages. You can see that they crossed at this point, which is where we made our lower high, and price then pushed lower. And you can see when these guys are both pointed down like this and there's a nice space between them, that level can be used to identify value within the trend. All right, so if we've got a bearish trend and these two moving averages are split apart like this, both pointed down, we can look to qualify shorts on price retracements up into that level. And you can see how well that held throughout this downtrend. Each push we had lower that came back into this level held and created lower lows. All right, so you can see that here, push up, held, lower low created, another push up into that level, lower high was created here, and then price continued lower, so on and so forth. All right, guys, so this works well on the daily time frame, especially your higher time frames. We also like to use these moving averages on the lower time frames. So how you can do that is if you're looking at a bullish trend, so we'll take the current price action right here, right, and we can see that prices have been moving higher since this breakout over 113. So let's just mark that on the chart here. And let's zoom in to the lower time frames and see, we can see that these bands or these moving averages were already both split and pointing upward before this breakout, which gave us a hint that this might move up to the upside, right? So on the 4-hour time frame, what you can see here is your first opportunity to jump in on this bullish trend on the lower time frames was a retracement opportunity right here. Price came into this level, we had held as support, then we had a little push higher, another move back down into that level, all right, and price has since pushed higher from here, right up into this level, and you can see we've used it as support again right here for a potential move higher. All right, guys, and the trend is still bullish here. So we see that we have a bullish trend on the daily, and on the 4-hour time frame, we had another pullback to this level of value within this bull trend. So what you can do here is you can start using this to qualify a potential trade back up into those range highs at the 118,640s, as we identified here on our daily time frame. So that's the target here, and that is how you can use these moving averages in your technical analysis toolbox to locate value in trends and to find potentially nice areas in pullbacks to look to ride back up to the upside. All right, everyone, so that was a quick breakdown on moving averages, two popular types of moving averages, the differences between them, as well as how to utilize them on your charts and how to add them into your trading plan as either a trend filter and or a dynamic support and resistance when the market is trending. All right, everyone, so I hope you enjoyed that and did find value from it. If you like what you saw, please feel free to hit the subscribe button and get updated on our posts as they come.